Good afternoon, everyone. Thank you for taking the time to join us today for this event. On behalf of Vijaya Diagnostic Center Limited, we welcome you to the virtual brokers and analysts meet on the announcement of the company's forthcoming IPO. Before we begin, I would like to introduce the management and distinguished guests who would be addressing today's gathering. From Vijaya Diagnostic Center Limited, we have with us Ms. Suprita Reddy, the Chief Executive Officer, Mr. Sunil Chandra Kondapalli, Executive Director, and Mr. Narasimha Raju K.A., the Chief Financial Officer. Representing the BRLMs, we have Mr. G.B. Jacob, Managing Director and Head of Capital Markets at Edelweiss Financial Services Limited, Mr. Santosh Verma, Executive Vice President at ICICI Securities Limited, and Mr. Anand Singh Chauhan, Associate Vice President at Kotak Mahindra Capital Company Limited. We have placed all microphones on mute. After the presentation, we will open the floor for questions. The questions can be typed in the Q&A panel available to you, and they will be read out to the management on completion of the presentation. I now invite Mr. G.B. Jacob from Edelweiss to initiate the proceedings.
Thanks, Gaurav. Good afternoon, ladies and gentlemen, and a very warm welcome to the broker and the analyst meet for the IPO of Vijaya Diagnostic Center Limited, the largest integrated diagnostic chain of South India. I would like to thank you all on behalf of the company and the lead managers for taking out your precious time to attend this meet. It makes me extremely proud to bring to you a company that started off with a very humble beginning in 1981, when the promoter and the chairman, Mr. Reddy, established the first integrated center in Hyderabad, which was also one of the first integrated diagnostic centers in India back then. From then on, in the last 4 decades, Vijaya has been on a track of expansion, and as on June 30, 2021, has 81 diagnostic centers and 11 reference labs across 13 cities and towns in the states of Telangana, Andhra Pradesh, NCR, and Calcutta. And today, it gives me great joy to see Vijaya IPO being the largest IPO in the diagnostic space that India has seen till date. At a time when healthcare assets are becoming even more crucial, particularly in radiology as well as in the pathology segments, we believe Vijaya Diagnostic perhaps provides the unique opportunity to investors, since it caters to the both segments of what I just spoke about. In our belief, it has got the right ingredients to become an investor's preferred choice, which are, it's in a sector which has seen one of the most best growth and has a lot of growth potentials as well. An extremely focused management team led by Suprita, who has been very passionate about the business, a unique integrated business model. As I mentioned earlier, in fact, they were the pioneers of this business model. Strong focus on the brand, which ensures the highest B2C revenue. And I will lay emphasis here, and I'm sure Suprita in our presentation will also take us through what it means, because it has the highest B2C revenue as compared to any chain, especially the listed ones. It results into one of the best financial metrics in terms of growth, EBITDA margins, return on capital employed, and ROE. Needless to say, it's also backed by one of the leading private equity investors in India, Kedara Capital. The key timelines of the issue, as you would probably know, the IPO is opening on Wednesday 1st September and closing on Friday, 3rd September, with the anchor scheduled for Tuesday, 31st August. The price band of the issue is 522 to 531, with the issue size of 1,894 crores at the top end of the price band. The IPO is 100% offered for sale by the selling shareholders. With this, I seek your support to make this IPO a very successful one. Thank you.
Thank you, sir. We also have a short corporate film which will provide more insight into the business of Vijaya Diagnostic Center Limited. Can we please have the video? Vivek, there's no
Center
sound.
Limited. The first step day that every journey starts with a single step. And for us at Vijaya Diagnostic Center Limited, the first step way back in 1981 was guided by a vision of our promoter and executive chairman, Dr. S. Surendranath Reddy. A vision to provide comprehensive, innovative and high-quality diagnostic services to our customers, all under one roof, at affordable prices in a customer-centric manner. All our laboratories hold National Accreditation Board for Testing and Calibration Laboratories (NABL) accreditation, and 3 of our diagnostic centers hold Patient Safety and Quality of Care (NABH) accreditation. Diagnostic services are provided by a medical professional team consisting of 71 laboratory doctors, 19 physicians, 106 radiologists, and 1,038 well-trained technical staff in our operational network. Today, we have become the largest integrated diagnostic chain in southern India by operating revenue, and also one of the fastest growing diagnostic chain by revenue for fiscal year 2020. The strength of our brand, integrated services model, quality of diagnostic services, infrastructure and customer experience are important differentiating factors which helps us in retaining our customers and sets us apart from our competitors. This customer-centric ideology is embedded in our work ethos. As an integrated diagnostic provider, we offer a comprehensive range of approximately 1,610 pathology tests, divided into 740 routine and 870 specialized pathology tests, and approximately 220 basic and 320 advanced radiology tests that cover a range of specialties and disciplines. We have an extensive operational network of 80 diagnostic centers, including those of our subsidiary companies. Our customer-centric approach includes home collection services in 9 cities in India, made possible through a robust technical capability and strong IT infrastructure. Our investments made in technology, the right team and processes have helped us implement a customer-centric model at our centers and ensured high brand recall and customer stickiness. One of the best healthcare brands 2021 by the Economic Times in 2021. Most Trusted Diagnostic Center of the Year India at the Indo-Arab Leaders Summit and Awards in 2019 and more. We are the largest and fastest growing diagnostic chain with dominant position in South India. Vijaya Diagnostic Center.
Thank you. I'm sure that video has helped throw some light on Vijaya's operating model and the ethos behind the business. I would now like to call upon the management team of Vijaya Diagnostic Center to take us through their presentation. Over to you, Susan ma'am.
Suprita, you are on
Give you an
mute.
introduction.
Yeah.
Can you hear us? Yes, we can now, yes.
Yeah, good afternoon, everyone. Before we move on in the presentation, would like to give you a brief introduction of our journey this far. So Dr. Surendra Reddy, our founder, his vision of providing comprehensive diagnostics all under one roof at affordable prices is how Vijaya was born. He's actually a first-generation entrepreneur from an agricultural family, was the first one in the family to have gone to medical school, is a doctor by profession, was working at a government hospital during that time, and that's also a time he realized that patients were having to go to different centers for their pathology and radiology needs, and that was causing a lot of inconvenience and a lot of delay in the treatment process itself. That's the time he decided to quit. This is way back in 1981. We started our first center in Himayatnagar, Hyderabad, in about 1,200 square feet, offering both pathology and radiology services. We continued to grow with the single center till the early 90s and realized a need to grow and expand and get closer to our customers. Started our second center, haven't looked back since then. We've grown thoughtfully, steadily, and conservatively over the years. And today, our operational network consists of 81 centers and 11 reference labs spread across 13 cities and towns of Andhra Pradesh, Telangana, National Capital Region, and Kolkata. We service more than 10,000 customers a day and perform close to 80 lakh tests a year. We have a team of close to 2,000 plus team members, doctors, and technical and operational staff that help us to maintain a unique and differentiated customer experience and also highest quality standards across all of these 81 centers. And being an integrated model and being able to offer everything from the most basic pathology test to the most advanced imaging test, we've been able to handle all the diagnostic requirements of our customers comprehensively. All this leading to our strong cash generation and return metrics. We are the largest consumer-facing business in the country today. 93% of our customers actually walk into these centers to get their services done, which has resulted in consistent profitable growth with negative working capital days. We've delivered industry-leading 40% plus EBITDA margins and about 20% PAT margins. Vijaya is known to be the leader in the industry for introducing many firsts, be it technology, advanced tests, or the best medical talent on board. In the year that we started itself, we introduced the ultrasound to the industry and later to the gamma camera, PET-CT, mammography, and many more, all of which actually resulted in us getting recognized and rewarded with a lot of awards like the best imaging brand, best healthcare brand, best diagnostic brand, etc. Like I mentioned, we are the largest integrated diagnostic in southern India. We've grown steadily and thoughtfully from 1 center to 81 centers in our geographies we operate in. We've always heard our customer and focused on servicing their needs and at the same time maintaining the highest quality standards. We've become the preferred choice of the customer in this region and created a loyal customer base over the last 4 decades. And we have been growing faster than the industry, as you can see in this slide. The outlook of the industry itself is very bright when it comes to diagnostics, and AP and Telangana are among the top 5 states when it comes to macroeconomic parameters like the per capita income, population growth, out-of-pocket healthcare expenditure. And as you can see in this slide, radiology has been growing faster than pathology. And we as an integrated one-stop model have been able to comprehensively handle all the diagnostic needs of our customers. In this slide, I'd like to explain to you on how we run our business and also how we grow and expand into new geographies. So we have 81 centers in our operational network, 11 reference labs, all of them are accredited by NABL. We grow in concentric circles. We go in first with our hub, which is the large format center, which is usually around 8 to 12,000 square feet and has a lab processing unit and advanced imaging like the CT and MRIs. Once the hub stabilizes and gets accredited, we start adding the asset-like spoke centers, which are our small format centers. Our small format centers, unlike a lot of pure path player centers would have, everything in pathology that we can offer, and in radiology from an ECG, X-ray, ultrasound to 2D echo, TMT itself can be serviced in a small format center. Our small format centers have almost about 12 to 13 skilled people to handle the center. The specialized and the super specialized departments that are not available in the hub centers are the only tests that go into our flagship centers, to name a few, cytogenetics, molecular pathology, PET-CT, etc. All this is controlled through an internal robust logistics network through road and air. In this slide, we wanted to show you what we are very proud of is the super high quality infrastructure with the best in class technology. So all of the centers of Vijaya have a unique look and feel to them. They provide convenience to a customer. Some of the centers that you see in these slides are in the tier 2 locations where we operate. So irrespective of the geography, all the centers of Vijaya will have state-of-the-art equipment. Being a 40-year-old business and understanding our customer and focusing on the highest quality standards, the trust that we've created with a very dense operational network, high quality talent coupled with high quality infrastructure, and most importantly, the best-in-class technology, the strong focus on clinical excellence with a wide variety of tests has made us the preferred choice in this region. We have the highest per footfall revenue and also the per footfall EBITDA, as you can see in this slide, because of the offerings that we can do because of being an integrated player. So our customers, the prescription is filled in completely here. And most importantly, the customer chooses to come to a Vijaya center, even if he's referred elsewhere. We are a technology-driven company. Like I mentioned, Dr. Reddy's vision was best-in-class technology coupled with at affordable prices. And in line with his vision and his long-standing relationship with companies like the GEs and the Philips, has helped us not in just getting better pricing on the equipment, but also Vijaya becoming a reference site to showcase their equipment. We have the largest pool of doctors today when it comes to a radiology team. And because of the technology and the talent pool that we have, we've become gold standards in a lot of tests like the epilepsy protocols and the neurograms. We present a lot of academic papers in the RSNAs and the ECRs. And when it comes to pathology, we were a fully automated bidirectional lab in the early 90s itself to avoid any kind of human intervention. We were the second lab in India to have been accredited by the NABL. We have a fully integrated radiology information system. This basically helps us to leverage technology to tap into our consultants sitting across different locations. So irrespective of the geography that we operate in, if we have a case that's done in one of the tier 2 locations and we have a talent pool sitting across different locations, the report is done by the specialists. So we're able to give a high quality report within the shortest possible time, creating convenience to the customer and immense trust to the medical fraternity itself. We have a highly committed board. We have 4 independent directors. Dr. Nageshwar Reddy Garu is the chairman of Asian Institute of Gastroenterology. He's the chairman, he's the Padma Shri and Padma Bhushan awardee. S.P. Singh is the ex-chief secretary to the government of Telangana. C.S.N. Murthy Garu is the ex-CEO of Origin Discovery and he also sits on the board of Gland Pharma now. Dr. Manjula Anagani is the clinical director and head of the Department for Care Hospitals for Women. She is also a Padma Shri awardee and also a Guinness Book holder. All of them bring in a lot of meaningful experience to the table. We have a fully built out team. Dr. Surendra Reddy Garu is still very active, passionate, comes into work every day. He oversees the clinical excellence of the company. Dr. L.T. Kishore comes in with over 28 years of experience and handles the radiology for us. Dr. Lata Kini comes in with over 25 years of experience, handles the lab operations and the quality departments. We have an ESOP plan in place. 0.83% of the company is held just not by the senior management, but by the loyal and the long-standing employees of the company. KPMG has been our auditor for the last 4 years. Of course, it's been a wonderful journey with our marquee investor, Kedara, who's helped us get in a lot of processes and also gets a great talent on board. I'd request Raju to take us through the financials, please.
Thanks. Good evening, everyone. Extremely thanks to take you through the stellar financial performance of our company. In fact, the superior financial metrics that we see on this slide are a pure reflection of our differentiated business model that is providing integrated service under one roof, and also the strong Vijaya brand that we have built over the last 4 decades. In the last financial year, we achieved 377 crore revenue. If you look at from 2017 to 2020, we have grown at a CAGR of 15 to 16%. This growth was largely driven by increase in the volumes, both in terms of the number of samples and also the patient footfall count. If you look at the impact of price, in this 15 to 16% growth, it was hardly like a 1 to 2%. This is again in line with our chairman's vision to provide quality diagnostic service at affordable pricing. You might have noticed in the past slides that Indian diagnostic industry is growing at a healthy CAGR of 12 to 13%. And we are proud to say that we have delivered a growth higher than this industry growth rate. If you look at our last 1 decade performance, our revenue base has increased by more than 7 times from 50 crore in 2011 to almost like 377 crore in 2021. Coming to margins, we delivered industry-leading margins like gross margin of above 80% and EBITDA margins of above 40%. These superior margins were possible due to the fact that we're a large B2C player, which is one of the key differentiating factors between Vijaya and the other peer group. And the second important factor which contributes to the superior margins is the operating leverage that we have in our hub and spoke business model, which is slightly different from the hub and spoke model that's being followed by the other large chains. Apart from this, since we have a long operating history of around 40 years, we also have the long-standing relationships with most of the vendors like Siemens, Beckman Coulter, Philips, Wipro G, all these multinational companies. we're able to procure all the materials at a highly competitive pricing. Not only the materials, even look at the services like your annual maintenance contracts or CMC contracts, and any of these medical equipments or radiology equipment, we're able to procure at a best prices, which was contributing to the superior margins. Coming to the return metrics, we achieved top quartile return metrics like pre-cash ROC of above 40% and return on net worth of about 20%. And as we're a large B2C player, we also enjoy a strong cash flow conversion of above 80%. And we have a negative working capital days, and we're a debt-free company. We just have 1 crore rupees of cash credit facility at one of the subsidiaries. And the business model generates healthy cash flows, due to which what we have seen is that there's a continuous increase in our cash and bank balances. Like in the last financial year, we had almost 220 crore plus cash and bank balances. And as of June 2021, we had almost like 250 crore plus cash and bank balances. In this slide, I would like to highlight that Vijaya has got the best-in-class financial and operational metrics. If you look at the first two important operational metrics, the first one is the revenue realization per patient, which is a crucial parameter in the diagnostic industry. You can see almost like a 1,200 rupees, around 1,200 rupees is the revenue realization for Vijaya per patient, and which is clearly like a 40% higher realization compared to the peer group. And if you look at the second important operational metric, that is average number of tests that we do per patient, we do almost like a 2.8 tests per patient. That means we do almost like a 10 to 12% higher number of tests compared to the peer group. So these two important operational metrics reflect the fact that Vijaya has got a completely differentiated business model that is providing integrated service under one roof with a strong focus on B2C segment. Thereby, it helps us to gain much larger share of the customer wallet as compared to the peer group. So one might think by looking at the 1,200 number, which is like a 40% higher realization, thinks that Vijaya is charging high prices. But there are a couple of reasons, as I explained. That is one important factor is that since we're an integrated player, we're able to perform more number of tests right from the pathology to advanced radiology. We're able to churn out more number of tests. Say, for example, another player is doing 2 tests per patient. We're able to do like close to three tests per patient, which is giving me higher realization. Apart from that, we have a large share of revenue coming from B2C segment, and also we have radiology mix. So it's a combination of these three factors, which is giving us almost like a 40% higher realization per patient compared to the peer group. So these factors are resulting into superior margins, as I highlighted in the previous slide, at all the levels, be it at a gross margin level or at the operating margin, operating EBITDA margin levels, and also at the PAT margin levels. We were able to achieve superior margins compared to the peer group. Thank you.
So the company also has a well thought out growth strategy going forward. So the first of these levers is we are talking about our home markets of Telangana and Andhra. These are our core markets where we have built this dominant position and the strong brand recall. And if you look at the size of the market, the diagnostic services market in these two states is about 5,100 crores, and we have a 7% market share. So this in itself gives us a huge opportunity and headroom to grow in these two states. And in fact, we are looking at a number of these tier 2, tier 3 locations where we will be adding centers going forward, and we'll be consolidating our leadership position in these two states.
And initially, if you'd see historically, most of these tier 2 or tier 3 locations, the infrastructure itself was not very developed. And of late, the ecosystem there, the medical infrastructure, there's a lot of development, and we see that there's huge room to grow in these markets. Out of the 81 centers that we already have, about 14 to 15 centers are present in these tier 2 markets, which we have gone earlier. And we feel that it's a market where we see sustainable growth, meaningful growth, and also deepen our position into our home markets and consolidate our brand position. With this, the second, here I would also like to bring out the point that adjacent geographies. Here, what I mean by adjacent geographies is the bordering states of Andhra and Telangana, the tier 2 and the tier 3 locations, where we would have people coming in historically traveling all the way to Hyderabad to get their tests done. Same like the tier 2 locations in Andhra and Telangana, we see that there is a huge improvement in the medical infrastructure, also the general ecosystem of these geographies. So we have a clear visibility on these locations and where we would be coming up in the next few years. When it comes to East India, I would just like to give you a little bit of history here. So we were handling a large hospital lab in the early 2000s, and once the lab started doing well, we had to exit that facility. But that was a time that we actually understood the East India market and felt it was very underpenetrated. And definitely there was no other player with best-in-class technology all under one roof like Vijaya present there. That's a time we wanted to actually go into the market. And as a follow-up to that, in the year 2014-15, we acquired a company called Medinova. Medinova was established in the year 1986, had a very strong brand recall in southern Calcutta, but due to management mismanagement and operational issues, the company was not doing very well. So we knew about that and we acquired this company in 2015, revamped it, reinvested in it, completely made it a new center. Now the Kolkata Medinova Center is almost like a hub of Hyderabad Vijaya. Is doing well. In fact, last year it did a turnover of more than 12 crores. And now it's ready to take on more centers as spokes in that geography.
So in addition to our organic growth strategy, which basically looks at, of course, strengthening our position in our home markets of Andhra, Telangana, and also going into new locations in adjacent geographies, as well as the focus on the Eastern Indian region. We also are quite open to any kind of acquisition or inorganic growth, basically. And of course, as you saw from the financial presentation, Vijaya is a debt-free company. We have fairly good liquidity on the books, which can actually allow us to look at any possible acquisition opportunities that come. We do have some factors that we look at. For example, we would definitely look at a fit in terms of the cultural value system. And importantly, it has to be a customer-centric focus. In other words, we will be looking more at centers with a B2C model, which is kind of aligned to our model rather than B2B kind of business models. And we would also like to see that they've built a brand recall and a brand visibility in the market that they operate in. Eventually, that's what we would be acquiring. The rest of the infrastructure or equipment is things that we can add. But buying a brand will help us in gaining visibility, getting a quick ramp up and penetration into a market. So this is something that the company is open to. And going forward, if we are able to actually evaluate and acquire some of these companies, then this would be inorganic growth, which would add to the organic growth of the company. So I think that's the last slide we have. So we'll be happy to take any questions.
Thank you, sir. Thank you, ma'am. We'll now open the floor for the Q&A session. We have already received some questions. So while we take those up first, I request everyone to post their respective questions in the Q&A panel. We will try our best to ensure that all questions are answered. However, in the interest of time, we may have to skip some repeat questions. The first question, out of the total 81 centers, how many of these are on a lease basis and how many are owned?
So out of the 81 centers, 78 centers are leased and 2 centers are owned by the company.
Thank you. The next question has come from 2 to 3 people. So I'll just club them into one. In your RHP, why has your benchmarking not been done against ThyroCare?
So firstly, I think we are an integrated diagnostic services company. So in a sense, there are no listed peers who have a very comparable similar model to us. Most of the listed players are pure pathology players, and they have a different kind of business model compared to our integrated model, where we actually have these large centers where we have both radiology, pathology, as well as advanced imaging. And we get most of our business through 93% of the business comes from patients who actually walk in and interact with us. So ThyroCare, in a sense, in fact, is a very different model where they don't interact with any of their patients. It's completely a B2B kind of a network, and samples are collected through a network. So in that sense,
Thank you, sir. Next question. Vijaya is 30 to 50% higher revenue per patient as per your offer document. What are your thoughts on the ability to maintain these as you grow?
As I already explained, our revenue realization per patient is almost like around 40% higher than the other peer group. And one important factor contributing to this higher realization is the B2C mix in our revenues. More than 90% revenues are coming from the B2C segment. Even in the strategy going forward, our focus remains same, that is customer-focused integrated service offering. So since our objective is to focus on the B2C segment, we are confident that this higher realization per footfall or per patient count remains same.
It's also because of the integrated model itself and being able to offer everything from the most basic pathology to the most advanced imaging tests all under one roof. The combination of tests per prescription, that's why you're seeing tests per footfall are higher, and that's also driving the per footfall revenue to be higher, and that's also driving the per footfall EBITDA to be higher. So 10 to 12% tests are higher in an integrated B2C model.
Thank you. Next question. Could you please talk about your center economics? For example, how many years before you break even on a center? And if the smaller towns will be able to offer enough traffic or volume for your operations?
Sure. Before we come to the center economics, I would just like to explain that all of our 80 centers have some amount of radiology in them. All of our centers are integrated, can offer everything in pathology, and in radiology, some would have basic and some would have advanced. So when we look at the center models and the concentric circle that we grow in, even when we go to these tier 2 locations, we have seen that it's a convenience factor for that region because it's also supporting a lot of rural villages in and around that area. And the hub model of Vijaya typically has a lab processing unit which is accredited, can offer a lot of niche tests that are not going to be available in a geography like that. So it's able to do way higher end imaging. So the volumes in these tier 2 locations that we have gone to have been way higher than even the metro city. And the break even for either model, the hub or the spoke, happens for us in the first quarter itself because of the strong brand recall that Vijaya enjoys in the geographies that it operates in.
Thank you. Next question. The growth in the eastern part of India for Vijaya Diagnostics, will it be through the Medinova vehicle or through the Vijaya Diagnostics brand?
So the plan is, of course, to grow under the Vijaya brand name. Medinova, of course, that one center which is located in southern Kolkata, because it's been in that region since 1986. We have actually co-branded it. So that continues as a co-branded center. It has both Medinova and Vijaya in the branding. But for any new centers in new locations, we will continue to go with the brand of Vijaya.
Thank you. Next question. Why has expansion so far not happened in the neighboring southern states? And what is the rationale for going to East India first?
So I think as we showed in our slide on growth strategy, we have been in the East since the mid-2000s. And when we were part of a joint venture. So when we were running that lab, we basically got exposure to that market. And a few of the things we realized is firstly that the market was underpenetrated. And in terms of just the competitive intensity, even though Kolkata being a city and a metro, it was far lower than any other city or metro in other regions of the country. So this was why we said that there is an opportunity to grow in a large region where there is much less competition. In fact, we did not see any comparable centers like ours, which had a high quality infrastructure, best-in-class technology, and a good B2C model. So it's more of a choice between going to a market where we are able to grow faster and achieve our objectives faster, versus going into a city where you are already having some established players and trying to gain market share from there.
Thank you. Next question. Rather, the next set of questions is around one topic, so I'll club them into one. Your revenue numbers would have been affected by the COVID tests or COVID-related tests that you conducted in Q1 FY22 and 21. So could you please provide us some sort of color on the proportion of COVID-related revenue?
So before we get to that, even though Vijaya Diagnostic was one of the first centers to have been approved by the ICMR to test COVID in Andhra and Telangana, the local regulations weren't permitting private players to test COVID. So testing of COVID in this region started only in Q2. So Q1 was absolutely no COVID testing. And for FY21, the COVID RT-PCR and the antibody test contributed about 14% of our revenues. And in Q1 of FY22, it was around 15% of COVID RT-PCR and the antibody testing.
Thank you, ma'am. Next question. Where do you see major growth coming from? Is it because of new markets being created, or because of smaller players giving away their share in the existing market?
It would be, I think, a combination of both. But for us, yes, we see that we will get growth from opening new centers. And also at the same time, there are, as a normal practice, we keep adding new tests every year to the menu, whatever new technologies come up. So that will also play a role in growth. But I mean, the smaller players giving market share away, that is a trend of consolidation which has been there for a long time. It's going to continue, but we don't see it becoming something which in a year or two will drastically change the industry.
Thank you. Next question. Why did the employee cost reduce in FY21 even though the sales have grown? Is it because the employees have been offered less cash salary due to ESOPs? Is that an explanation?
Gaurav, the reason for decrease in the employee cost was not on account of the ESOP. In fact, our ESOP plan is quite unique. The breadth of the ESOP plan is like even a phlebotomist in our company was eligible to get the ESOPs, not just the manager and above. The entire talent pool was eligible for the ESOP plan, almost like 0.8% of the share capital on a fully diluted basis is held by the ESOP shareholders. And the reason for the decrease in the employee cost was in the first quarter when our revenues were impacted since the COVID testing was not allowed in this area by any private hospital or diagnostic center. So due to the lockdown and the pandemic situation, when the employees were requesting to take off because the business was decreased in the first quarter, we have allowed them to take the off. We have not did any retrenchment of any employee. We promised them that their jobs are safe, and then we continue to them. And because of this reason, because of their absenteeism in the first quarter, when the business was low, the employee cost was low. Again, from the Q2 onwards, when the testing started, since being in the diagnostic industry, we were the COVID warriors, and all the employees resumed to the work, and then we were successfully able to do higher number of COVID testing in this region, almost like 3.5 lakh COVID RT-PCR testing we have done.
Thank you. The next question is a kind of follow-up to this. So the same question about other expenses, which have reduced by around 400 bips versus FY20 in FY21.
Yeah. In the first quarter, as I was mentioning, when the revenues were impacted due to the COVID first wave, and then we were not able to do the COVID testing due to the regulatory framework, we had to undertake certain cost control measures, due to which certain expenses were low, like certain AMC contracts and certain rental expenses, etc. in the first quarter, which was the reason for the decrease in the other expenses.
Thank you. Next question. Your higher operational profitability seems to have been aided or helped by the economies of scale that you've derived through your regional focus. As you expand in other regions, how will it impact the margins?
Yeah. You might have noticed that there has been a continuous expansion in our margin profile, like from 35% EBITDA margins, we have moved to more than 40% EBITDA margins. And one of the important factors contributing to this margin expansion is the operating leverage that we have in the business model and also the way that our cost structure is aligned. And when you come to the sustainability of these margins, when we go into the tier 2 and tier 3 cities, we're fairly confident that the margin profile will be continued, because what we see is that even though the revenue realization per footfall is slightly lower in the tier 2 and tier 3 cities, the cost structure is also correspondingly lower in these tier 2, tier 3 cities. And apart from that, what we have seen is that whenever we venture into these tier 2 cities with a large hub center format, we have seen a higher number of footfalls compared to a hub in Hyderabad city. So due to these reasons, we're fairly confident that the more than 40% EBITDA margins are fairly sustainable, even though we penetrate deep into our core markets in the tier 2 and tier 3 cities.
Thank you. There are a number of questions around center economics again, so I'm going to club them into one. What is the typical fixed cost investment for setting up one center, and how much time or either number of tests approximately does it require to hit break even?
So, Gaurav, coming to the capex that is required for centers is slightly higher compared to the other peer group, because the model itself is different. Like we have a best-in-class infrastructure across the centers, across the 80 centers, we have the best-in-class infrastructure. Also, we provide integrated service. So we also have the radiology equipment across these 80 centers. We have two types of center formats. Basically, that is, one is the spoke center format and the other one is a hub center format. So across these centers, because of the brand recall, the strong brand recall that we have in these markets, we are able to achieve these break-even across these centers within the first quarter itself. And coming to the capex that is required for these two types of center formats, based on our experience, what we have seen is that to set up a spoke diagnostic center, which is like a 1,800 to 2,000 square feet in size. It's not like a small collection center like with a 300 or 400 square feet. It's a large center up to like 2,000 square feet with the entire basic radiology service like an ultrasound machine, X-ray, etc. So typically we need like 90 lakhs to 1 crore capex. And for a hub center format, since it's like a large center format, like almost like 8,000 square feet to more than 10,000 square feet, and we have a processing center in these hub centers whenever we penetrate into tier 2, tier 3 cities. And also we have the advanced radiology modalities in these hub centers like an MRI and a CT scan machines. So typically what we have seen in our experience is that it requires around 11 to 12 crore rupees of capex. And as I mentioned, in both these type of center formats, we are able to achieve the break-even in the first quarter itself because of the strong brand recall that we have.
Thank you. Next question. Given the huge headroom for growth in the market, why isn't the company trying to grow at even faster revenue levels by deploying the cash pile that it has, even if it leads to some margin reduction? So it's a question on the trade-off between growth and margin profile.
So basically, Gaurav, I think in a comprehensive integrated model, because we also have pathology and radiology and we do these larger format centers, it is not just the capital which drives growth. We also have to look at the availability of the right kind of doctors, team, personnel, and also in terms of stabilizing the center operationally and finding the right location to start with when we're looking at some of these hub centers. So if you look at us historically, probably 10 years ago, we were at a point of time where we were opening only 2 or 3 centers in a year. And if you look at the last 2-3 years, we've been opening about 13 to 14 centers every year. So this has come about because we've built an entire back-end system in terms of having a projects team, having our L&D training for new staff that are recruited. We've also built a huge radiology team now. We have more than 110 plus radiologists. And we also have a radiology network so that people can sit in any one location and report any other location. So a lot of the constraints which are there in the operational expansion of this kind of model, we have already been able to address. So again, I think the challenge is to keep growing and increasing that rate of growth, but also not do it at the cost of the customer experience. So we don't want to dilute the customer service levels, and we also do not want to dilute those profitability metrics that we have built over time. So that's kind of been the journey. And going forward, yes, we will see increasing growth. But to answer that question, yes, it's not about capital. We already have capital even on the books of the company.
Thank you. Next question. Given the sort of growth and margin expansion that we have seen, Vijaya is very well placed at the moment. But why have the selling shareholders chosen this moment to sort of cash out?
So, to answer that, of course, we have a private equity investor, and as everybody on the call knows, they do have some fund life and other considerations based on which they decide when they have to exit an investment. However, they actually own 40%. Post issue, they will still continue to own 10% in the company, which also is because of their, I think, the great journey they've had and the confidence they have in Vijaya's future growth strategy.
Thank you, sir. Next question. Does the government policy on establishing PPP centers in government hospitals pose a threat to your business model, or would we be open to participating in these?
So actually, there is no threat, and in fact, we have evaluated PPP from the first tenders that came out, and we just found that fundamentally our business model is quite different. In PPP, you're participating in a tender, so it's a government-facing business. The government gives you a fixed duration of time in which you can put a machine in a government hospital and run it. So what happens at the end of that period is not known. And also there is a certain amount of receivable-related issues. Because in our B2C model, customers walk in, we realize the payment immediately. But in PPP, you have to receive this payments from the government. And also the pricing which was being quoted in some of these competitive tenders, we looked at the prices and said, at that price, it's very hard to offer a high quality service, to not compromise on the quality of an MRI that I do or the quality of the reporting that I do. And that is the reason we have stayed away from it. But we've had no impact. In fact, there are many locations in Andhra Telangana where we have a center and there is a government hospital with a PPP machine. And our business has been doing fine. We have not been impacted at all.
Sure. Thank you. Next question. What is the revenue split between radiology and pathology? And how have these two revenue lines scaled up in the past 3 years? And which of them is the focus area going forward?
Out of our revenue, 65% of our revenue comes from pathology segment. 35% of the revenue comes from the radiology segment. Over the period in the last 3 years, what we have seen is that this revenue mix, 65 is to 35%, almost remains same because of the fact that across our centers, we provide both the pathology and radiology services. And coming to the focus area, providing this integrated service, both pathology and the radiology under one roof, is the core DNA of the company. So going forward, also the same strategy will continue. And if you look at the diagnostic industry as well in the earlier slides, both the pathology and the radiology segment, both are going at a CAGR of 12 to 13%. And our focus is on both the segments.
Thank you. Next question. You follow a very well structured hub and spoke model, which has helped you attain economies of scale and increase efficiency. But do you think it could restrict you from doing significant geographical expansion because it requires a very detailed setup of centers?
So, Gaurav, basically, if you look at our current growth rate, we have been growing faster than the industry average growth rate. We're growing at 15-16%. And as I mentioned earlier, we are actually the largest integrated chain, and we've over time built this ability to roll out these centers so that year on year we have been increasing the number of new centers that we open. So I think we are very well placed. Also because we have focused on this B2C space. That's been our area of expertise, and I think that's the most sustainable business where it's harder for competitors to enter, and that's where the profitability also will be higher because you actually kind of have a direct interaction with your customer. It's a consumer-facing business. So we are quite positive about the future of our growth strategy.
Thank you, sir. There are a number of questions on the utilization of the cash balance that we have. So could you please tell us what are your plans to deploy the cash on books in terms of dividends or inorganic or organic growth?
So as of now, I think the priority is to look at growth. And as we mentioned in our presentation, we are quite actively evaluating any kind of inorganic opportunities in any of the areas, any of the markets that we have interest in. So I think that is the priority, to use it for growth, either inorganic or even maybe in terms of organic. If we end up having more number of centers, more number of hubs coming up, then we will need the capex to be invested. Dividend, of course, the company has a policy. It's also part of our the filings, the DRHP. So, but as of now, yes, the purpose I think is to look at how to grow the business.
Concentrate on how to grow the business.
Thank you. Next question. Would it be possible to share if the margins of the different segments, radiology and pathology?
Yeah. Coming to these margins of our company, we are able to achieve gross margins of above 80% and the operating EBITDA margins of more than 40%. As you know, we provide both the services under one roof. That is, at the same center, we're able to provide both the services. So there are various common costs involved. That is like your front office staff cost, your center overheads, power and fuel, etc. There are various common costs are involved in the cost structure. And since it's an integrated service offering, we cannot really bifurcate the EBITDA margins between these two segments. But definitely at the gross margin level, we can look at the segment-wise performance. For a radiology segment as a whole, at the gross margin level, we have almost like a 90% plus margins.
Thank you. Next question. Does Vijaya have any centers under the franchisee model? And if not, is there any plan to offer any centers under franchisee model?
So Vijaya does have one center under the franchisee model. It's more like the company-owned franchisee operated because of the capex involved in the radiology equipment coming in. So we have one hub center that functions under the franchisee model in an area called Karimnagar. And even in future, we would look at a combination of centers in the franchisee and the company-owned centers going forward.
Thank you, ma'am. Next question. Would you be able to share what is the market share of the company in its home market and in South India overall?
So as I think mentioned earlier, Gaurav, in the Andhra, Telangana home market, these two states, the total out-of-hospital diagnostic services market is about 5,100 crores, and that's growing at 12 to 13%. And our market share in that is about 7%. Now, for South India, I don't think we have any accurate data on the exact size of the market, so that we don't have that to share with you.
Sure, sir. Thank you. The next question is around valuations. Could you please explain to us how you've arrived at the current price band, and maybe the bankers can take this one?
Bankers can.
So Gaurav, maybe I'll take that. Not sure. Am I audible, Gaurav?
Yes, JB, you're audible.
Okay, thank you. No, I think a very valid question. And what we did was we kind of met multiple investors across the multiple geographies, and we have taken their feedback in terms of how do they value Vijaya, and the price band has been kind of fixed in consultation with a lot of the anchor investors that you will potentially see on the 31st. And we believe it's an attractively priced IPO where there is some money left on the table for investors for participating in the IPO as well.
Thank you. Next question. Is there any margin difference? And if yes, how much between the centers in tier 1 and tier 2 or 3 cities?
So, Gaurav, I think Raju had answered this a little earlier also. When you compare a tier 2 market versus something in a city, tier 2, even though there is a small difference, let's say an 8 to 10% reduction in price, we also see that operational overheads are lower by a smaller factor. And secondly, more importantly, in our experience, if you look at all our hubs which are in tier 2 locations in Andhra, Telangana, the number of footfalls that we are getting is significantly higher, by about 20% compared to our hubs in the city. So as a combination of those three factors, we have found that there's no real difference. Maybe a very small 1 to 2% difference might be there because of RAM. But other than that, we have not seen any big difference in the margins we are seeing at a
tier 2 versus a metro.
city.
Yeah.
Thank you. We're coming to the last few questions now. The next question reads, how is our net working capital a negative 149 days? Is it like a one-time thing or is it a part of the company's business model?
Yeah, it's part of the business model. You might have noticed that more than 90% of our revenues comes from the B2C segment. When you have a B2C segment revenue, it is the amount is collected across the counter. So we have very, very less trade receivables on the balance sheet, almost like 7 to 8 crore rupees of trade receivable on a revenue of 377 crore rupees. So the negative working capital days is based on the business model. It's not a one-time in nature. So what we have seen in the past, and also since we are focused to grow in the same integrated service offering with B2C focus, we believe that the same negative working capital days will continue even going forward.
Thank you. Next question. You appear to have a listed company in your group, which is Medinova. Are there any plans to amalgamate this with your company once you get listed?
So at the yes, Gaurav. So Medinova is a BSE listed company and it's a subsidiary of Vijaya. But at the current point of time, there is no such plan to merge these two companies. Post our listing, of course, this is something that has to be decided on by the shareholders of both the companies and the boards of those companies, both the companies together, in the best interest of both company shareholders. But as of now, no plans.
Thank you. Next question. What are the growth drivers in a post-COVID world for Vijaya?
Well, I think, Gaurav, the pre-COVID world is going to hopefully, the post-COVID world will look just like the pre-COVID world. So the growth drivers are going to be the same. I think, we will continue to do what we have done, the same integrated services, B2C model. We enter new regions using our hub and spoke. And once the hub stabilize, add the spokes around it. And of course, we continue to be the first to bring in any new technology, any new modality. So adding new technologies or new tests will also add to the growth. But yeah, that's hopefully what we will go back to shortly once we are over this pandemic.
Thank you. Next question, and again, this is from a couple of people. Could you please clarify on how centers hit break-even in the first quarter and the capex that you mentioned? That has, I think, not been understood clearly.
Okay, I'll clarify it in detail. Okay, I was talking about the break-even. The P&L cash break-even happens quickly at both our center formats, at the spoke center format also, and at the hub center format as well. The break-even happens quickly in the first quarter itself. Coming to the payback period, at the spoke center formats, as I mentioned, the typical capex that is required is almost like a 90 lakhs to 1 crore. So the payback period at these spoke centers is typically like a 12 months to 18 months period is the payback period for these spoke centers. And coming to the large center format, that is the hub center formats, we don't look at the payback on a standalone hub center. Because the whole idea of setting up a hub when we go into a tier 2 location or even in a city, okay, the whole idea is that once the hub stabilizes over a period period of say like 12 to 14 months, then we keep adding the asset light spokes around the hub. So we measure the performance as a cluster as a whole. So typically based on our experience, we see the payback period for a cluster as a whole is somewhere between 3 to 3.5 years is the payback period.
Thank you, sir. Next question. What is the nature of legal and professional fees in the company? It used to be 15 to 16% of revenues until FY20 and then declined sharply. So could you please explain this?
Yeah. You might have noticed that, in our presentation that we have a large talent pool of almost close to 200 doctors, out of which 100 plus doctors are specialized in radiology. As we are an integrated player, we have both the radiologists and also the pathologists in our company. And typically these doctors work on a consultant mode. So the expenditure of these doctors, almost like a 200 plus doctors, it is appearing under the legal and professional charges. We might have seen that from 2020 to 2021, there is a decrease in this cost because when the business was down in the last year Q1 due to the COVID, due to the cost reduction exercises that we had to do, the cost was reduced in the overall legal and professional expenses. And the nature of these legal and professional expenses is the doctors' consultancy fees to our in-house, almost like a 200 plus doctor talent pool.
Thank you, sir. And the final question for today. After the offer that is post-issue, what is the stake that the promoters will retain in the company and how much will be public?
So after the offer for sale, the promoter and the promoter group will hold around 55% and 10% will be held by Kedara and Karakoram and 0.3% will be held by the pathologists and the radiologists and 35% will be held by the public.
Thank you very much, ma'am. Thank you very much, sirs. That brings us to the end of the Q&A. I now invite Mr. Santosh Verma from ICICI Securities to give the vote of thanks.
Hello, everybody. Thank you for taking us through this presentation and highlighting the key aspects of the issue. Given Vijaya's strong positioning as a trusted diagnostic brand since decades, we hope that this issue will see a blockbuster response from investors. The company is the largest integrated diagnostic chain in Southern India by operating revenue and one of the fastest growing diagnostic chain by revenue for fiscal year 2020. I would like to thank all of you for attending this meeting and sharing your thoughts with us. We look forward to your support in making this issue a huge success. Just to summarize the issue before we sign off, the IPO consists of an offer for sale of 3.57 crore equity shares, aggregating to rupees 1894 crore at the upper end of the price band. The price band is rupees 522 to rupees 531 per equity share of face value of rupees 1 each. The offer constitutes 35% of our post-offer paid-up equity share capital. The IPO opens up for subscription on 1st September and closes on 3rd September 2021. With that, I would like to close this presentation. Thank you all of you for attending the same.
Thank you, sir. Thank you everyone for joining the virtual brokers and analysts meet of Vijaya Diagnostic Center Limited for their forthcoming IPO. Unfortunately, we could not take up all the questions due to paucity of time, but please feel free to reach out to us for any further queries or email us at ir@vijayadiagnostic.in or ipo@adfactorspr.com. And we will do our best to reply to your queries within 48 hours. Take care and stay safe. Thank you.
Thank you.
Thank you. Thanks so much.
Thank you. Bye.